All right, welcome back. We are now proceeding with question 4. We are still on the same paper, that is November 2020 in bracket 2 exam. We started by doing question 3. I hope you have all captured it correctly. And we are now proceeding with question 4. Then after question 4, we will then decide which question to go back to. But our intention is to ensure that we do this whole paper and finish it. And the reason why I started with these 3 and 4, it's because the observation when we are marking accounting scripts is that most of these learners, they leave this question blank and they tend to rush and do the income statements and the balance sheet where there is a lot of calculation. And where there is theory, they just ignore because they believe that theory is difficult, whereas it is the most easiest, so long as you have the right interpretation and you know the concept and you are clear with what you are doing. The chances of getting it 100% correct, they are very high. So that is why I would invite that you pay undivided attention as we are now doing question 4, which is a new question, because these questions were not there in our previous papers, the 2019s, the 2018s, and the 2017s. So this one is almost a new question, which is corporate governance, question 4. Question 4 was based on corporate governance. Shareholders and employees associated with the company will be particularly interested in whether the company is well governed and managed by the directors. At the AGM, the shareholders will elect 2 types of directors. The first type of director will be the executive directors. The executive directors, they attend board meetings and they work as the company on full-time basis. It is very important that you clearly understand the difference between the 2 directors. There is executive directors and there is also non-executive directors. So the executive directors are those that they attend board meetings and they work at the company on full-time basis. They are permanently employed by the company and they are working on full-time basis. But the non-executive directors, they also attend board meetings, but they do not work as the company. Those are the non-executive directors. So you are provided with 4 aspects of corporate governance that will be of a concern to the stakeholders. 4.1, that's the audit report, which is 4.1, the audit report. The first question in 4.1, it says, explain why a qualified audit report is not a good reflection of a company. Provide 2 points. Remember, after a thorough audit that will be conducted by the independent auditors, the independent auditors then write a report. And the reports that we may expect from the independent auditors, they vary. The first one that all companies are always expecting is an unqualified report. And an unqualified report is an excellent report where everything in the company has been done correctly, where the financial statements are in accordance with the GAAP and they are in the manner that is required by the Companies Act. There is also a qualified audit report, which is not a good report. A qualified audit report is not a good report because this report is indicating that maybe 1 or 2 aspects could not be verified. Maybe there is information that is missing and therefore the auditors will then issue a qualified audit report. There is also a disclaimer of opinion report, a disclaimer which is a very bad report. A disclaimer of opinion when it is issued by the auditors, it is when the financial statements are not in compliance with GAAP, they are not in the manner that is required by the Companies Act, they did not even comply with the International Financial Reporting Standards. So the disclaimer is a very bad report. But our first question under question 4, here it says, explain why a qualified audit is not a good reflection of the company. Provide 2 points. So I think from what I've been explaining, you can be able to provide an answer. When it says it's not a good reflection of the company, it's because this report indicates that there is information. It indicates that some information is unclear, or maybe there is an information that is missing. Some information indicate that some information is unclear, it's not clear, and maybe that there is information that is missing, which is not a good reflection of the company. And this may result to a company losing. The company may lose potential investors. If the potential investors see that this company has been given a qualified audit report, so they may not want to invest in that particular company. So this company may lose potential investors. And we are not looking at it in the point whereby it's losing the potential investor. They may even lose the existing shareholders. When the existing shareholders get to realize that they have been issued with an audit report, so therefore they may decide even to leave the company if they have been issued with a qualified audit. So this qualified audit report has got a very negative impact on the company. Even when the company is applying for loans in the bank, they may not be granted loans because of this qualified audit report. They may even be charged when it comes to things like when they are submitting for their tax returns. They may not get, they may not save money from their taxes because it is clear that some of the information here is missing and is not there. And this is also reflecting that there is lack of internal control, which is a very important point. This qualified audit report is showing that there is a lack of internal control. This is another point that you may include, because if there is proper internal control in the business, therefore the company may not get a qualified audit report. So let us then proceed to 4.2. 4.2, explain why it is important for a company to include the non-executive as well as the executive directors on the board of directors. Explain why it is important to include the non-executive as well as the executive directors on the board. So this one, in this question, if you just look at it generally, if a company has got only the executive directors, it means the opinions that they will be getting on the management of the company will be coming from one perspective, from a narrow view of the executive directors. But if you also include the non-executive as well, people who are coming from outside with the necessary expertise or with the necessary skills required by the company to improve, they may add more value to the company. So more opinions. So we are saying, the question is asking, why is it important for a company to include the non-executive as well as the executive director? We are saying that if we have the non-executive and the executive, more opinion from different views may be obtained, and thus may result to the company being improved if we are having different views. And remember, the non-executive may also act as watchdogs. This is an accounting concept, watchdogs. Remember, even the external auditors, they serve as watchdogs to the directors. They are there to prepare to protect the rights of the shareholders. Even the non-executive directors may also act as watchdogs to the executive directors. And therefore the executive directors may not do as they please, because they know that there is also another sector of the directors, which is the non-executive directors, who will be there in the meeting, who will make them to account if there is anything that is going wrong in the business. So we are therefore saying that it is to the advantage of the company when the company has got the non-executive and also the executive. Remember, the non-executive directors, even though they are not working on permanent basis in the company, but the people who are selected to serve as the non-executive are the people in most cases who are highly qualified and who have got the necessary experience required by the company to guide when decisions are taken. So considering that the executive directors are working on permanent basis in the company, they may be having that narrow view of the company, and therefore bringing on board some people from outside will therefore increase opinions that will be brought into the company, and thus the company will improve. Right. And another thing that we may also consider when it comes to the non-executive are important. And remember, the non-executive may not be as expensive as the executives, because the non-executives are not working on permanent basis in the company. So they only come there to sponsor their expertise and then they leave. So it is a better idea that they are those people who are employed as non-executive, so that they are able to assist the company. And then 4.3, according to the Companies Act, a company must have a remunerations committee, explain the role and give reasons why this committee is necessary. A company must have a remunerations committee. So we needed to have an explanation why, explain the role and give reasons why this committee is necessary. So the role of this committee, which is the remunerations committee, is to decide and approve salaries or bonuses. They have to decide and approve salaries and bonuses of the workers. So their role is to ensure, they are there to ensure the role of the remunerations committee is to decide. They have to sit down, the committee needs to sit down and decide, and they also have the responsibility to approve salaries and bonuses of the workers. Their main role is to ensure that there is fair remuneration of all employees of the company, so that the directors may not just decide on how much they give and they do as they please. So there has to be a committee that will sit down and look into all considerations and therefore decide that this is how people are going to be paid and how much are going to be the bonuses for this current year, and make a consensus decision with regards to that. And remember, in a committee, all parties are represented in that remuneration committee. So therefore, a decision cannot be made by only one person, and therefore make a decision which will be benefiting him or herself. So it is therefore important that there is a remuneration committee. And remember, this is according to the Companies Act. So it is something that is in the legislation. If something is according to the Companies Act, it means that if the company does not have the remunerations committee, so it means that company will be in breach of the act and may be charged for that. And number reasons for that, number reasons for the explanation. What is their role? It is to decide and approve salaries. Number reasons for that, we don't want a situation whereby directors should not be the only one deciding. This is to prevent fraud which might happen and to prevent the reasons for this committee. The role of this committee, you need to be very clear with the role of this committee. That this committee is to ensure that they sit down, they look at all the factors, they look at all considerations, they then decide on how much are the workers going to be paid, are we going to have bonuses this year, and make sure that there is a fair remuneration to all employees. And the reasons for that is to make sure that the directors should not be the only one deciding. They should not be the only one deciding on salaries. They should not be the only one deciding on salaries. And this might, if they are the only ones deciding on salaries, we might end up having a situation whereby the directors are paying themselves more at the expense of other workers. And this is also to prevent fraud, and this is to ensure that there is fairness in the distribution of salaries. There is fairness in the distribution of salaries. Right. 4.4. 4.4. Directors engage with clients on a regular basis in an effort to negotiate contracts and do increase sales and services. Directors engage with clients on a regular basis in an effort to negotiate contracts and to increase sales and services. So we are required to explain why there should be a company policy for all gifts, donations or favors received by the directors from clients to be declared to the board by the directors concerned. Provide 2 points. So it means that there is a situation whereby we will find that some of the service providers will be giving gifts to the directors. They are giving donations to the directors on their personal capacity, and according to the Act, those gifts must be declared. And this question is therefore asking us, why are those gifts have to be declared? Why is it important? It is said, explain why there should be a company policy for all gifts, donations or favors received by the directors from clients to be declared to the board by the directors. Provide 2 points. And the first point, we want transparency. The first point, that is transparency in providing or in awarding tenders. We want transparency in awarding tenders. So what we are saying, the reason behind this act of saying that this donation should be declared is that this donation might also be viewed as bribery. These donations, they might be viewed as bribery if they are not declared. So that is why we are saying it is important for the directors to declare. Because let's say there is a situation whereby a service provider has given a donation to a director on a personal capacity, and suddenly that service provider is awarded a tender from that particular company. One may end up viewing that as bribery. So that is why we are saying it should be those donations and gifts must be disclosed, so that when whatever that is happening in the company, there is transparency. There should be transparency even in awarding tenders. The necessary processes must be followed so that we know that all legal processes have been exhausted before one is awarded a tender. And therefore we are saying that these donations, if they are not declared, they must be viewed as bribery. So the main idea behind the article, you can see that some of these answers, you don't need to like copy it from the book or get information. You just, some of them, they require your general reasoning as to if a person is given a gift by a service provider. It's a clear indication that this gift, maybe this service provider wants something in return. So therefore, it is important that that gift must be disclosed, so that we ensure that when we are awarding a tender, the right processes have been followed, and that they may not be viewed at a later stage as bribery. So this is 4.4. This was only just 4 questions from question 4, which was based on corporate governance. And if we may just quickly recap on what we have discussed, we were looking at the impact of the qualified audit report, that the qualified audit report is not a good reflection of the company. And we had to provide 2 reasons as to why we are saying it's not a good reflection. It is because we know that when an audit report is issued, it means there is something that is not right in the financial statement. Maybe some of the documents could not be verified, some of the expenditure could not be verified, or maybe some of the documents which were required for audit purposes were not produced by the directors, and therefore it indicates that some information is missing or is unclear. So that is why we are saying it's not a good reflection. And we are looking at it from the point that even the existing holders, if the company is getting a qualified report, they may even decide to leave the company. And if we look at 4.2, where we were looking at the importance of the non-executive and the executive directors, we said the executive directors, they are just working there on a permanent basis in the company, and the non-executive are those who are also the members of the board, but they are not working on permanent. They only attend meetings, and in most cases, these people are highly qualified and they possess necessary skill that is required or expertise that is required by the company. So when they are brought into the company, they then bring that necessary expertise, and therefore they are able to guide even the executive directors in taking decisions. We said if there is more opinion from different views which may be obtained, and thus the company will improve. And even the non-executive may also act as watchdogs. They may be, because the executive directors will not do as they please if they know that there are some people who are also watching over them. And then 4.3 was when we were looking at, according to the Companies Act, the role of the Remunerations Committee. The Remunerations Committee is a committee that is required to decide on the salaries. And why is it necessary that we need to have a committee like that? It is because we don't want a situation whereby there is one person deciding. The directors are the only one who are making a decision. And remember, the directors are also the employees of the company. So they may take the decisions which will benefit them and disadvantage other employees. So it is therefore important that we have a remuneration committee in place which will be taking decisions in that regard. And then explain why there should be a company policy whereby gifts given to the directors must be declared. We are saying that if those gifts are given by the service providers, and at a later stage that service provider is awarded a big tender, that might be viewed as bribery. So we are saying whatever gift or donation given to a director must be disclosed or must be declared, and that when the company is awarding tenders, there should be transparency in awarding tenders and make sure that all processes are being followed. So that was it with question 4, which is coming from the November 2020 in bracket 2 exam, which was written in 2020, and this brings us to the end of question 4.